Hey, hey, hey!
Hey, hey, hey!
Welcome to my channel on everything real estate. I'm Sean Kelly, and this is Chapter 8. Welcome back. We have 20-ish questions on Chapter 8, which is covering agency contracts. If you're new, I'd greatly appreciate if you hit that like button and subscribe by clicking the buttons down below. If you're looking for the full general review Chapter 8 video, I'll have that linked right up here or down in the description. Stick around because I will be launching a cram session series, which will be like 3 to 5 minute long videos with no ads, no introductions, just pure cramming information into your brain. Anyway, let's dive into some questions. Question 1. Samuel Seller lists his property with exclusive realty. Eventually, Samuel convinces a coworker, Wanda Wish, to purchase his home. In which situation would Samuel not owe a commission to exclusive realty? An open listing, a percentage listing, an exclusive right to sell listing, or a net listing? So, C is your typical type of listing, a listing that is only giving to one broker no matter who sells the property for the most part. A percentage listing isn't a thing that I know of, and a net listing is where a broker gets a certain amount of commission. So the answer here is an open listing. Any broker that procures a sale, or if the seller sells it themselves, then no commission is given. Answer here is A, open listing. Question 2. Earnest money is synonymous with consideration, typically held in a trust account, a minimum of $250, or all of the above. So this is an extremely easy answer once you've been in business for really your first transaction. Earnest money is held in a trust account. You give this to the closing attorney in most cases. They put it in a trust. B is the answer. Question 3. Which of the following clauses is required by the North Carolina Real Estate Commission to be contained within every listing agreement? So this is a very important and probable test question here. So in an attempt to not really confuse you, remember the keyword anti-discrimination clause. So the answer here is D, anti-discrimination clause. Know that this is required for listing agreements. So basically, don't discriminate on the basis of race, color, religion, sex, handicap, familial status, national origin, sexual orientation, or gender identity. Question 4. Steve Seller needs to receive $180,500 from the sale of his house after paying the broker a 5% commission. How much must the house sell for? Okay, so you take that 100% minus the 5% commission for 95%, then divide the $180,500 by that 95%, to get $190,000. Answer here is A. It's not so bad, right? Math isn't so bad. Question 5. The exclusive right to represent buyer agreements must have all of the following characteristics except being in writing, having a definite termination date, specifying provisions for an automatic renewal, or D. Incorporating conspicuously the commission prescribed description of agent duties and relationships. So in the real world, you send this over to your client sometimes before an offer is made. It most definitely needs to be in writing, and it does have a termination date that you fill in. Now that would leave me with C and D, which you don't really see as an agent, so this must be something in the old textbook. C is the answer here, which makes sense because there is a termination date for a reason. So an automatic renewal provision isn't something that's absolutely needed. The answer here is C. Question 6. Lewis purchased a home for 2 years ago for $120,000 by paying $30,000 as a down payment. Assuming that the value of the home has increased by 10%, by what percentage has the equity also increased? 6.8%, 31.8%, 40%, or 46.7%? So the $30,000 is the original equity that was put in, right? The initial amount that was put in. The total value now is $120,000. And then increase 10%. So you multiply that together for a $12,000 increase in dollar value. Then you take that $12,000 divided by that $30,000 of initial investment. And so that is a 40% increase in equity. The answer here is C, 40%. My mouth is already dry and I just started this chapter. Question 7. The type of listing agreement for which the seller will owe the listing agency a commission regardless of who sells the property is A, open listing, exclusive agency listing, exclusive right to sell listing, or co-brokered listing. What this is asking is, what is the typical agreement that you would normally see on your day-to-day business? This is not an open listing where any broker or seller can claim commission, right? That doesn't sound normal. It's not an exclusive agency where, although it's one broker, the homeowner can sell themselves and not pay commission to anybody. It's an exclusive right to sell. See, that is the normal way where the agent gets a commission basically no matter what happens, whoever sells that home. Question 8. Which is true of a valid listing agreement in North Carolina? It must contain a non-discriminatory clause. It may be oral up to the presentation of the first offer. It requires the seller to sell if a full price offer is made by a buyer. It can contain an automatic renewal clause if both parties agree to it in writing. So this is the same answer that came across a few questions ago. It must have a non-discriminatory clause, which is very similar, if not the same, to the anti-discrimination clause. It's just this different way of saying that. So B, it may be oral. Listing agreements can't be oral. A seller doesn't have to accept any offer, like what it's saying in C. And there is no automatic renewal clause, which again was answered in a previous question. So the answer here is A. It must contain a non-discriminatory clause. Question 9. By the way, if you haven't watched my How to Pass the Real Estate Exam, I have a tip in there, which I believe I've already mentioned in another chapter review. But if you read some of these questions and you skip one because you don't know the answer, eventually some of these questions may help you answer previous questions that you had to skip. So if you don't know an answer, skip over that, mark it, highlight it, move on, and then maybe when you come back, you could have learned it from one of these other questions. Question 9. The buyer originally paid $150,000 for his house by paying $25,000 down. If the house is now valued at $160,000, by what percentage has his equity increased? 22%, 40%, 6.25%, or 5%? So the increase in equity is $10,000, right? Because it's $160,000 minus $150,000. That's $10,000 in growth. So then $10,000 divided by the $25,000 down is a 40% gain again. This is very similar to the previous answers too. Answer is B. Question 10. All of the following will automatically terminate a residential listing agreement except expiration of the listing period, death of the seller, death of the listing broker who works at a large residential firm with many agents, or sale of the house. So the expiration will end the agreement. Remember, there's no automatic renewal. The death of the seller will terminate as well, because they're the ones holding the asset. The sale of the house obviously terminates it because the job was done, right? So the answer here is C. If the agent dies, it's still the firm that holds that agreement. It's a firm listing, right? It's not with you, the broker, and the seller. It's with your firm. It's with the agency, not with you. So the answer there is C. It's an agency agreement, not a Sean Kelly and seller agreement. I'm going to rudely interrupt this segment to remind you that I am affiliated with Keller Williams, and I have a million reasons as to why that is. But I'm just going to stick this out there. If you decide after interviewing all of the firms out there that Keller Williams is a great fit for you, definitely consider putting Sean Kelly down as your sponsor. I'm over in the Mooresville, North Carolina location. We could be awesome referral partners. It's a huge deal for my business and helps me keep creating content just like this rather than just purely buying and selling homes for my clients. But let's carry on. Question 11. Christy has sold a property which was listed at a 5% commission rate with another firm for $240,000. The listing firm agrees to a 50-50 commission split with the selling firm. Christy's company will charge a 5% franchise fee on all earned commissions and will then pay her 65% of the remainder. How much did Christy earn on this sale? Alrighty, so 5% commission for $240,000 is $12,000. Half of $12,000 is $6,000, right? So half goes to one side, half goes to the other the party. So the firm takes 5% from Christy, so that's $6,000 times 95%, because that's 95% is what she's keeping. That is $5,700, and then you pay her 65% of that. So $5,700 times 65% is $3,705. The answer here is B. So I'm not really sure in the real world what a franchise fee is plus the 65%. Like most branches just say, at least with Keller Williams, your agent split is 70% or 80%, right? It's whatever it is. It's just that one amount. It's not 5% here, 3% here, 60% there. It's just, we're just going to let you keep 70 or 80%. Question 12. They do that to confuse you, you know? Question 12. The clause in a listing contract that protects the broker's commission entitlement beyond the listing term in the event of a sale of the property by the owner to a prospect who was shown the property by the listing firm or its agent is called a... So the answer here is B, the extender clause. This is in a listing contract and protects the broker's entitled commission for a certain period of time after the expiration of a contract. Imagine if you're a listing agent with an agreement until September 1st, right? And the house doesn't sell by then. But someone you showed the house to decides to buy it a little bit later on like let's say September 2nd, like the day after your agreement ends. You have rights to that commission as an agent. The answer there was B. Question 13. Which of the following would likely not constitute a violation of the Sherman Antitrust Act? A boycott of a discount brokerage's listings, agreement with competitors to set commission rates, the refusal to replace advertisements in a local paper that accepts ads for sale by owners, or a firm's raising of its own commission rates. So one of these answers stands apart from the others. A through C all discuss some sort of collusion or movement against others. D is a firm raising its own commission rates, which is completely acceptable. The answer here is D. Question 14. The rate of commission to be lawfully charged in a real estate transaction is set by the local MLS, the Association of Realtors, the Sherman Antitrust Law, the firm, and the seller. So as previously stated already in another question, commission can basically be whatever the seller and firm agree upon. You just may not get that much if you charge an outrageous commission percentage, right? So the answer here is D, between the firm and the seller. Question 15. An investor paid $150,000 for a property that he sold 4 years later for $210,000. What was his average annual rate of profit? Annual rate of profit. The profit here is $210,000, right? Minus the $150,000 that an investor paid for it. That's $60,000 remaining. Then you divide that by the $150,000, which is a 40% profit. But then you need to divide that 40% by 4 years, sorry. So that's 10% because it asks for the annual rate. The answer is A, 10%. Question 16. The primary difference between an open listing and an exclusive agency agreement would be the seller retains the right to sell the property himself and is not liable for a commission. Seller can list it with as many brokerages as he wishes in the open listing. The exclusive agency agreement stipulates the firm is the only one that can sell the property and be entitled to a commission regardless of who sells it, even the seller. Or the seller can sell it himself in the exclusive agency agreement, but is not allowed to sell it himself in the open listing without being liable for the commission, which that one is the opposite of what it is. So this one should be obvious from a previous question we've already answered, but the answer here is B. Open can list with as many brokerages as he wishes. Question 17. A property recently sold for $225,000 at a commission rate of 6%. If the firm collects a 6% franchise fee from the total commission and then pays the agent 55% of the remainder, how much did the agent make on this transaction? There's a typo there. So the total commission is $225,000 times that 6%, right, which is $13,500. Then you multiply that $13,500 by 6%, which is an $810 franchise fee. So the remaining is $13,500 minus the $810, which gives you $12,690. And then you do that times the 55%, which is the actual firm split, which will give them $6,979.50 for remaining agent commission, which answer is C. Question 18. Angela wishes to net $25,000 from the sale. Is that another typo? Is that me or is that in the book? It has to be me. From the sale of her house after paying off her loan of $121,900 and the miscellaneous cost of $3,500 and a commission of 6%. What should be the selling price of the property? So what you do here is you want to add up all the cost and that net amount there. So $25,000 plus $121,900 plus the $3,500, which will give you $150,400. So then you divide the 94%, which is 100% minus the 6% commission, from the $150,400 to get a sales price of $160,000. So the answer here is D. Okay, there you have it. That wraps it up for Chapter 8. This is a great chapter to study in preparation for the state exam. Chapter 9 is up next. Remember to subscribe. See ya.